Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at Ausbiz. Let's see what happened in the overnight session. Global equities mostly higher, while US Treasury yields and the dollar fell on dovish commentary from Fed policymakers. However, trade on Wall Street was choppy after rallying in the previous session. The Nasdaq was dragged lower by Apple on reports that it continues to lose market share to Chinese rivals in China, and Tesla dropped on news that it's offering discounts on its Cybertrucks for sale in the US. Bank earnings continued to be in focus, with Morgan Stanley advancing after the lender said earnings increased in the fourth quarter, propelled by a wave of deal-making that drove its revenue to a full-year record. Shares in the second largest bank, Bank of America, fell despite beating profit expectations and predicting higher interest income in 2025. US Bancorp reported a rise in fourth quarter profit, helped by an increase in trust and investment management fees, yet its shares were off more than 5%. Now, elsewhere, United Healthcare shares slipped after the health insurer reported fourth quarter revenue below estimates. Well, US Treasury yields have fallen further, with investors reacting to Federal Governor Christopher Waller saying 3 or 4 interest rate cuts this year are still possible if US economic data weakens further. He flagged a possible rate cut in March, saying the inflation data we got yesterday was very good. If we continue getting numbers like this, it's reasonable to think rate cuts could happen in the first half of the year. And the latest data shows increased sales of motor vehicles boosted overall US retail sales by 0.4% in December, which were weaker than expected. However, core retail sales were up 0.7%. And the number of Americans filing new jobless claims increased more than expected last week. Now, US rate futures are now pricing in 40 basis points of rate cuts this year. The yield on the 10-year Treasury note is down to around 4.63%, the 2-year at close to 4.25%. Meanwhile, Scott Bessent, US President-elect Donald Trump's nomination for Treasury Secretary, has said extending Trump's 2017 tax cuts was a top priority, while vowing to ensure that the US dollar remains the world's reserve currency. Well, the dollar has weakened further overnight, while the Aussie is trading at 62.1 US cents. And Bitcoin has, earlier in trade, actually, it reclaimed that $100,000 level, has just fallen back slightly there. On the commodities front, oil prices have settled lower, and expectations that Yemen's Houthi militia will halt attacks in the Red Sea, and Brent crude futures are down around 1% at $81 a barrel. Copper up more than 1%. Similarly, iron ore up close to 2% to $103 a tonne. And the gold price has climbed to a 1-month high on weaker bond yields. US gold futures more than 1% higher at $2,750 an ounce. Now, stateside, there is that focus on earnings kicking off with the big banks. I caught up earlier with Ken Leon from CFRA Research for his take on those bank earnings.
Banks delivered what the markets needed. There was questions about, is there more upside? And what we saw with the largest global US banks was strong performance across most of their businesses. They also had the ability to show that with the new Trump administration, there's opportunities maybe for more of a risk-on environment in the capital markets. So I think it was a good week for the banks. And my view is, given that many of these banks were up over 40% last year, the only way that you can grow into your valuation or multiple is upward earnings revisions from the consensus or the street analysts. And we saw that this week, and I think we'll see it in the next few quarters.
You mentioned the incoming Trump administration. That appears to be reflected in some of the commentary we're getting from the bank chief executives. For instance, we've had Goldman Sachs saying there's been a meaningful shift in CEO confidence. Just what has that amounted to, given the policies likely from the Trump administration?
Yeah, let me walk you through that. So one of the concerns was that the banks would be required to have much higher capital build from Basel III endgame, but what is in the U.S. interest is to let the banks really open up and lend to the U.S. economy. Likewise, we've seen really very restrictive policies from the Biden administration, whether it's the Department of Justice, the FTC, or parts, quite honestly, of the Fed. And I think what we're seeing is a more pragmatic, pro-business environment that even the American Banking Association has sued the Federal Reserve Bank on really the annual stress test, which really dictates how much the banks, and they're overcapitalized, can return to shareholders dividends and share repurchases. So we're all mindful of the 2008 financial crisis, but these are very strong banks and they're gaining wallet share around the globe.
Ken, let's break down some of the results we've had then. Most recently, Morgan Stanley, profit more than doubling. How did you see it?
Morgan Stanley is the premier leader in wealth management. It speaks to having durable, recurring fee revenue with the elevated equity markets. That means that the client balances really work into fees for Morgan Stanley. Likewise, we have this delta of how much of an upside is there in 2025 over 24 for investment banking. It was up strongly in the fourth quarter, but there are some lagging areas like mergers and acquisitions. Finally, when we look at Morgan Stanley, strong balance sheet, they are investing in technology, AI, and compensation as a percentage of revenue actually went down, mostly because of the volumes feeding into revenue.
Elsewhere, Bank of America, see the shares actually came off, but it did beat profit expectations. They're also, interestingly, predicting higher interest income for this year.
Yeah, we have buys on these stocks, and Bank of America has one leg into the more bullish capital markets and also global banking, but they also have one leg to consumer banking and community banking. And we did see really a year over year, just modest gains, maybe 1 or 2% for revenue, card income, same thing. But we're not seeing any concerns in terms of credit risk or an accelerated provisions for loan losses, which were really pretty mild in the fourth quarter.
Elsewhere, JP Morgan Chase, what about a 50% increase in net income?
Yeah, JP Morgan, a little bit broader than Bank of America with the capital markets. And, I think what we saw here were pretty good results, but not the outsized results of a Goldman Sachs or Morgan Stanley, mostly because a JP Morgan Chase or a Bank of America or even a Citi, 55-60% of the revenue is net interest income. And that has kind of eased off a bit.
Yeah.
The non-interest income areas are up like 30-40%.
Now, you mentioned Citi. What did you make of its result?
Citi's moving along. I think the market really took note that they have a new major share repurchase plan put in place, 20 billion. They also are executing, so we're beginning to see not only the strength of their treasury services business, but they're actually doing well in the capital markets as well, particularly areas of investment banking. But I think what Citi is, they're still the only bank trading at a discount to book value is kind of closing that gap. And I think that buyback gives investors confidence that there's going to be each quarter improvement for Citigroup.
Goldman Sachs, biggest quarterly profit for what, more than 3-4 years perhaps?
So we have a strong buy in Goldman Sachs really since late summer last year. Again, my point about net interest income being kind of an anchor that stops you from going faster, but for Goldman, it's only about 15% of their total revenue. So the two things are happening. They are re-energizing their asset management business, and they're also looking at opportunities to be much more engaged with private equity and private capital, either as an agent or as a principal investor. Additionally, they're getting that delta of the upturn that we already talked about for investment banking across the board, which I think the Trump administration will help create. Last point is for all these banks, a high percentage of their revenues, even greater than the historical average, is coming from the US. So any improvements that we see in Europe or Asia are good for these global banks because it will give them some additional opportunities really to drive their franchise.
Ken, any other results there that we haven't got across that you're of interest?
I think it's for investors, keep in mind that the financial sector, CFRA is overweighted. We think these banks are critical because they're in five are in the top 10, which represents 65% of the financial sector. What does that all mean? It really means stay with the largest market cap stocks. These are the winners. It's been true in technology and it's true in financials. So we like the global banks.
And Ken, you mentioned the potential opportunities, particularly with the incoming Trump administration. What are the risks as you see them right now?
Well, the risk for a regulation would be any delay in the appointment of key positions, but or also a global event. I think it's broader than just the Trump administration. To me, it's that black swan event that could be murking in a complex derivative trading, which impacts not only the party at risk, that was Credit Suisse, right, over 2 years ago, but it would also affect strong, solid banks around the world. So the black swan event is nothing we can anticipate, but it's the one risk I think that's most exposed for these banks.
Ken Leon from CFRA Research. Let's come back locally then. Ahead of the open and SPI futures are up just over 0.1%, and we'll get right across that when we get underway in just a couple of minutes' time.